Here at Matthews, we believe active investing is the best way to leverage growth and mitigate risk. A key component to achieving this is focusing on country, markets, and domestic issues. At the end of the day, country matters for two reasons. First, because typically the better the outlook for country macro, so the more conducive to growth will be the environment in which companies operate. Fluctuations in the likes of economic activity, money supply, inflation, interest rates tend to be more extreme than in developed markets, leading to steeper slopes in economic cycles and influencing more acutely structural growth potential. The second reason that country matters is because of the different valuations investors will attach to similar businesses operating in different countries. The reality is that investors tend to be more willing to attach lower risk premiums or higher valuations to countries with the hallmarks of free markets. By that, I mean countries prioritizing rule of law, a fair judicial system, robust industry regulatory governance. Even a whiff of nepotism or failing checks and balances against abuse of power will see investors mark down valuations. And this year, we need only look to a market like Turkey for such an example. Well, as active managers, we're looking to generate alpha. Regardless of index composition, we're looking bottom up for those great business models with excellent management, strong financials, all at the right valuation. Now, investable universes tend to be deeper in their heavier EM-weighted markets like China, India, Taiwan, and Korea, but we do find great businesses in the smaller markets like Philippines and Indonesia, and even in off-index countries like Vietnam. Of course, we're always mindful of the risk-reward setup. As we've touched on, some of the smaller markets may have higher political risk, institutional participation may be lower, and liquidity thinner. So that's something we need to factor in, not just to a higher required margin of safety, but also into our position sizing. As we know, the only constant really is change. You recall that the year began with a cacophony exalting US exceptionalism, of expectations of further strengthening of the dollar, and there were few concerns around global trade. Fast forward, and we've been to the brink and back on tariffs, and the market's view on the dollar has flipped. Then at the country level, we've had a flurry of unforeseen political and geopolitical events, from martial law in Korea, a suspended prime minister in Thailand, dramatic escalation of security risks in the Middle East, to, in Indonesia, investor suspicion towards the new incoming President Prabowo's policies. As active managers, we need to decipher between what's just market noise and what's actually important cyclically and structurally. In some cases, that might require the portfolio manager to have the fortitude to stomach volatility and hold on to his portfolio. In other cases, it might mean altering the portfolio as new information makes it more evident that the distribution of future expected returns is likely to differ from one's initial thesis. Let's start with Brazil. The last few months have witnessed unexpectedly high reciprocal tariffs from the US. This, a subsequent related uptick in President Lula's approval ratings, and rising worries around Brazil's weak fiscal position have all combined to roil the markets. That's pushed market valuations down to low levels, both absolute and relative to history, at a time when the local currency, the real, is already undervalued. We see a great setup for investors with two strong market catalysts around the corner that should narrow the prevailing wide price-value gap. Namely, the first being the beginning of a rate cycle. Recall that Brazil has been the only major economy in the world that's been actually increasing rates in 2025 to the point that real rates are at about 10%. And second, some electoral self-help. I'm referencing here the October 26 presidential elections. We see great opportunities in rate sensitives, select turnaround stories, and some small cap sectors such as retail and education. The second country example would be Vietnam. Tariff threats from the US in April really shook fear not just of an impending cyclical downturn, but also of possible threats to Vietnam's powerful structural story. That's one of high FDI and a young, hardworking labor force. However, strong actions from the new, more pragmatic, more growth-focused General Secretary To Lam, and ultimately a more favorable tariff outcome salvaged the Vietnam story. Now, like any frontier market, in Vietnam there exists political, regulatory, and governance risks. However, foundational knowledge that we at Matthews have built up over the years and a growing universe of high-quality listed companies has made the market a great fishing ground for alpha generation for active managers like us.